The world's most important oil route just stopped working again. Ships are stuck, oil can't move, and many countries have already run out, and some are running out fast. Prices are rising, and fear is spreading. For everyday people, this means higher fuel costs and empty shelves coming soon. But while others panic, Canada may have a hidden advantage. With its own oil and space to grow, this crisis could turn into a big chance if Canada moves fast enough. The Strait of Hormuz just shut down. Crude carriers from the Gulf stopped moving. Trading houses pulled their ships. Tanker after tanker sat idle in open water with nowhere to go. Every country that routes energy through the Middle East lost access to it simultaneously. The most critical energy corridor on the planet went dark, and the global pricing system that had been built around the assumption of its continued operation began recalibrating in real time. Oil that could not move was worthless, regardless of what the paper price said. And the countries that had structured their energy security around Gulf supply were now staring at reserves measured in days rather than weeks. One country does not route energy through the Middle East. That country is Canada. Canada has a pipeline running to the Pacific Ocean, moving 890,000 barrels of oil flowing west every single day, not to the United States, but to Asia. It has an LNG terminal on the coast of British Columbia, shipping natural gas to South Korea at 170 ships a year at full capacity. It holds 163 billion barrels of proven reserves, the fourth largest on Earth, with 6 million barrels a day in production. And most critically, every barrel of that production travels on a route that does not touch the Strait of Hormuz, does not cross the Red Sea, and does not pass through a single choke point. 10 days to Asia. The Middle East route, when it was functioning, took 20 days, and it is no longer functioning at all. Every country that just lost its energy corridor is now looking at the only country that does not need one. And that country had been building toward this moment for a decade. For years, Canadian oil sold at a massive discount to American buyers, sometimes $40 to $60 per barrel, below benchmark prices, while Middle Eastern oil moved at a $10 freight premium. That pricing structure made sense in a world where the United States was Canada's only customer, and Gulf supply flooded global markets with low-cost alternatives. It does not make sense in a world where $10 oil cannot move because the corridor is closed. When global crude hits $100 and the alternative routes are either shut down or overwhelmed, Canadian oil is not expensive. It is the most reliable supply available at any price, and the market is repricing it accordingly. Canada is no longer a captive supplier with one customer and no leverage. It has options. The world is already lining up. India, with 1.4 billion people, imports 90% of its oil, and half of it had been flowing through the corridor that just shut down. India entered the Hormuz crisis with less than 10 days of emergency reserves. The country's top diplomat turned to Canada and delivered a statement that captured the severity of the moment in 7 words. We are willing to buy whatever Canada is offering. Whatever, not some, not at the right price. Whatever Canada is offering, that is not a negotiating position. That is a country with 10 days of reserves and a closed supply route, speaking the language of genuine desperation. Japan imports nearly all of its energy and is fully exposed. South Korea is already buying Canadian LNG in what may be the most strategically sound long-term energy agreement signed this decade. Europe spent years cutting Russian gas after 2022, and now the Middle East route that was supposed to replace part of that supply is at risk simultaneously. Oil, natural gas, LNG, uranium, Canada has all 4 on a route that avoids every maritime choke point on Earth. Every country in this situation knows it. And they are willing to pay premium prices for guaranteed supply that does not depend on a single corridor that can be closed by a regional conflict. The specific irony of the American position in this crisis is structural and severe. The United States imposed 25% tariffs on Canadian energy, called Canada the 51st state, and told the world it did not need its northern neighbor. Then the Strait of Hormuz closed. The country that tariffed Canadian oil just made Canadian oil the safest energy supply on the planet. The country that publicly declared it did not need Canada just created the conditions that prove it does. And now Canada is adjusting prices to reflect that new reality because the leverage that Washington's tariffs were supposed to exploit has not only evaporated, but reversed. There is a deeper layer to this that Washington did not anticipate. 6 months ago, the United States pressured India to stop buying Russian oil. India complied and replaced Russian supply with Gulf crude, the exact oil that cannot move now. America forced India off Russian supply. Then the corridor India needed shut down. And India is now buying Canadian oil at prices reflecting global scarcity rather than the old captive supplier discount. The United States built Canada's Asian customer base by accident through its own foreign policy pressure on India, through the trade conflict that pushed Canadian producers to diversify, and through the military action that closed the alternative supply route those new customers needed most. This did not happen by accident on the Canadian side either. For years, Canada's own energy ministers described sending 97% of oil production to a single buyer as a strategic blunder. The country spent a decade building its way out of that vulnerability. Trans Mountain nearly tripled Canada's Pacific export capacity. Non-US exports jumped 289% in a single year. China alone bought 100 million barrels in 11 months. LNG Canada, the largest private investment in Canadian history, at $40 billion, built in northern British Columbia, shipped its first cargo with the terminal running at operational capacity. A second pipeline to the Pacific is coming, adding 1 million more barrels per day, with an Indigenous co-owned route assessment underway and a submission expected by July. 7 more energy projects are in the development queue. No other country on Earth has this combination of reserve scale, production capacity, infrastructure reach, and geopolitical stability simultaneously, not one. For American consumers, the pricing consequences of this shift are immediate and direct. When Canada was selling 97% of its oil to the United States with no alternatives, American refineries could dictate prices. Canadian producers had to accept whatever discount American buyers offered because there was nowhere else to send the barrels. That leverage is completely gone. Canada now has buyers in Asia willing to pay global market rates driven by supply disruption and scarcity. Every barrel Canada sells to India or Japan or South Korea at $100 is a barrel that does not flow south at the old discount price. If Canadian oil is worth $100 in Asia, and shipping costs are roughly equivalent whether the destination is California or Seoul, there is no commercial logic for selling to American refineries at $70. Canada will either demand prices reflecting global scarcity or redirect supply to buyers willing to pay it. American refineries dependent on Canadian crude, particularly in the Midwest, where Canadian supply dominates import infrastructure, now face a binary choice: pay global market rates or lose supply. Trans Mountain expansion alone returned $1.7 billion to the Canadian government last year at pre-crisis prices. When global crude hits $100, that figure multiplies. Alberta oil sands employ over 150,000 people directly and hundreds of thousands more across the broader supply chain. Every dollar of additional revenue per barrel flows through the Canadian economy, through Fort McMurray, through Kitimat, through Prince Rupert, not the American one. Saskatchewan is capturing uranium value. British Columbia is capturing LNG value. Multiple provinces are seeing pipeline construction employment across thousands of positions. 18 months ago, these communities were told Canada had no choice. Today, Canada has more choices than it has ever had, and every one of them was built, not given. The buyers Canada is gaining through this crisis are not temporary. Long-term pipeline contracts are not signed for a single disruption. They are signed for decades. South Korea's LNG deal is permanent infrastructure. India's uranium contract with Saskatchewan covers 10 years of supply. The Second Pacific Pipeline is permanent capacity. Every country that just discovered it cannot depend on Middle Eastern supply, is looking for a supplier that does not depend on it either. That supplier is Canada. And that supplier now has the pricing power to demand terms reflecting actual value rather than the historical discount relationship that Washington assumed would be permanent. America tariffed Canadian energy. Then it created the crisis that made Canadian energy essential. The question that nobody in Washington wants to ask out loud is what happens to those tariffs and to the pricing agreements that assumed Canada had nowhere else to go now that Canada just found somewhere else to go?